Welcome back to the deep dive. Today, we're really getting into it, looking at two big forces shaping entertainment right now in 2025. We're talking raw audience demand, what people want to see, and the hard numbers, the corporate finance side. We've got some great sources lined up that show us exactly where the money's going, both from consumers and, well, within the industry giants themselves. Our mission today is kind of twofold. First, we absolutely have to discuss this number that's just smashing records. It's a huge figure coming from a genre a lot of people might underestimate.
That's right. You really can't understand the theatrical market today without looking closely at horror. So we'll dive into what's behind the genre breaking its all-time box office record already here in 2025. We'll look at the economics using Blumhouse as a kind of case study. And then we pivot. We're shifting gears from, the box office results straight to the boardroom view. We're exploring those crucial Q3 earnings previews, basically what analysts are looking at to gauge the health and the future strategy of the 5 biggest media companies out there.
Okay, let's start with that number then. This absolutely massive figure. We're talking $1.2 billion generated globally by horror films this year.
Yeah, the scale is just, well, it's remarkable. Our sources confirm it. $1.2 billion globally for horror movies so far in 2025. And like you said, it didn't just squeak past the old record, it completely smashed it.
Right. And just for context, when was the previous record set? Because, it feels like horror's been pretty consistent for a while now.
It has. The last peak was back in 2017. That year, the genre brought in $1.16 billion. So fast forward 8 years, and 2025 is the new benchmark. It really shows how incredibly strong and, frankly, how important horror is for theaters now, especially, when getting people to leave their house for any movie is a bigger ask.
Yeah, and this is where it gets fascinating for you, listening and trying to figure out where cinema is headed. Why horror? Why is this genre often made on, let's be honest, pretty modest budgets, the one that can reliably pull people off their couches, especially when some huge blockbusters are, well, struggling sometimes?
It really boils down to that connection between the movie itself and the communal experience.
Yeah.
The analysis we looked at suggests horror has this built-in reason why you want to see it in the theater. It's not really the same at home. And that's exactly what exhibitors, the theater owners, are looking for, something that consistently draws people in, a reliable pull.
So it's not just about getting scared, it's about getting scared together. The shared gasps, the jumps.
Precisely. That's the core appeal, according to these sources. Experiencing fear or tension with a crowd, in a big dark room, you hear the reactions, you feel the energy. Your fancy home theater setup, no matter how good, just can't duplicate that specific feeling.
That makes perfect sense. It makes horror sort of inherently social, communal, and that makes it vital for the theater business model. When you buy that ticket, you're paying for more than just the movie. You're paying for that shared reaction, that participation. And horror delivers that pretty consistently. And crucially, like you mentioned, often on a much smaller budget than, say, a massive action movie that needs a gigantic opening just to break even.
And that's the key economic point. That reliability often translates into a very healthy return on investment, ROI, for the studios. In a market where a $200 million film is a massive gamble, these modestly budgeted horror flicks can offer a dependable revenue stream. It makes the genre almost, recession-proof in some ways. Critical for studios specializing in this kind of thing, high concept, lower financial risk.
Okay, and when you talk about high-concept, lower-risk genre movies, Blumhouse is the name that immediately comes to mind. They practically define that model. So what did our sources show about their year? Because it sounds like it's been a bit of a roller coaster for them in 2025.
Yeah, Blumhouse is a perfect example of the whole genre's risk-reward thing. They definitely had a needed rebound this year. A lot of that was thanks to Black Phone 2. It seemed to connect well with audiences, delivered that solid return we talked about.
But you said rebound, which implies they needed one. They hit some bumps earlier in the year.
They did. It wasn't all smooth sailing.
This is where it gets interesting, right? The genre's having a record year, but even the leader in the space has its ups and downs. What were the films that didn't quite hit?
Well, there were 2 notable ones earlier in 2025 that kind of misfired, according to the analysis. One was Wolfman, and the other one, and this was the real surprise analysts pointed out, was M3GN 2.0.
Wait, M3GN 2.0? Really? But the first M3GN was huge. It was everywhere in 2023. A genuine word-of-mouth hit, tons of buzz online, people loved it. How does a sequel underperform? That seems counterintuitive.
That's exactly the paradox the sources highlighted. The failure of M3GN 2.0 was unexpected because the first one was such a runaway success. It kind of suggests that, yeah, audiences want that communal horror thrill, but maybe they're also getting pickier. demanding more novelty, more invention, even within a sequel. Perhaps just seeing the familiar name or character isn't enough anymore. It might feel redundant instead of like a guaranteed good time.
Hmm, that's a really important point. It kind of pushes back against the whole IP is king idea, doesn't it? A known killer doll isn't automatically a hit. You still have to deliver something fresh. But Blumhouse, they're known for moving fast. They don't tend to linger on misses.
No, they don't. Their whole model is built on speed and volume. They're already looking ahead. They've got Five Nights at Freddy's 2 slated for December. That's their strategy.
Yeah.
Modest budget, aim for that communal experience, learn quickly, and move on to the next project. Accepting that some sequels or concepts might strike out is just part of their calculus.
Okay, but doesn't the failure of something like M3GN 2.0, which seemed like a sure thing, suggest that maybe moving too fast carries risks? Like audience burnout, even for a studio that gets the genre. And that rapid pace, well, it needs a stable foundation behind it, right? From the parent company to absorb those misses. Which actually brings us perfectly to our next part. Looking at the financial health of those big media giants, the ones funding everything, and the Q3 reports are key there.
Exactly. That's the crucial link. Blumhouse's model, the success of Black Phone 2, balancing out the miss of M3GN 2.0, that only works if the big companies distributing and funding them are financially solid. And those Q3 earnings reports, they're like the ultimate health check. Our sources lay out the framework analysts are using right now to interpret them.
So just to be clear, we're not predicting the results here. We're talking about what Wall Street is looking for. The specific metrics that will color their perception of the industry's health going forward. Who are the main players under the microscope this quarter?
Yeah, analysts are focusing on 5 key companies. Their Q3 performance really sets the tone for market sentiment and investment strategy. We're talking Netflix, Comcast, Disney, Warner Bros., Discovery, and Paramount.
Okay, let's maybe walk through those. The sources give a pretty good idea of the specific things analysts are watching for each one. Let's start with Netflix, the big streamer. What's the focus for them in Q3?
Right, for Netflix, it feels like the conversation has really shifted. It's not just about adding subscribers anymore. It's about the quality of those subscribers, how much money they're making per user. So analysts were watching 2 main things. First, that average revenue per user, or ARPU. Is it holding up or growing globally? And maybe even more critical now, how is that ad-supported tier doing? Is it successfully bringing in revenue? The market really wants to see proof that Netflix's pivot towards profitability, rather than just chasing growth at all costs, is working and sustainable. Are they maximizing revenue from the users they already have?
Got it. Okay, next up, Comcast, which is directly relevant here because, as you mentioned, Blumhouse sits under Universal Pictures and Universal is owned by Comcast. So what's the analytical view on the parent company?
Well, Comcast is managing a mix of businesses, some growing, some legacy. Analysts are watching the resilience of those traditional businesses, particularly cable and broadband. Historically, that's where their big free cash flow comes from. And that cash flow is basically what allows them to fund things like Peacock, their streaming service, and absorb some ups and downs in the film division, like with Blumhouse. So if that core cable broadband business shows more weakness than expected, you'll likely see pressure mount to cut costs, maybe including content spending.
Okay, that makes sense. Then there's Disney, probably the most watched, given its size and all the changes they've been going through. What's the main focus for their Q3 preview?
With Disney, it's still largely about balancing streaming ambitions with the health of their physical world assets. Analysts are laser-focused on the path to profitability for Disney Plus and Hulu. They need to see those streaming losses continuing to shrink. That's key.
Yeah.
But just as important is how their parks and experiences divisions are performing. Those parks are a massive and usually very stable source of revenue. They help offset the huge investments in streaming and content. So Wall Street wants to see that the whole Disney flywheel parks feeding content feeding parks, is still turning effectively.
Right. Next on the list, Warner Bros. Discovery, a company still very much dealing with the aftermath of that huge merger, especially the debt load.
Exactly. For WBD, analysts are tracking primarily 2 things. First, how quickly are they paying down that debt? That's priority number 1, cleaning up the balance sheet. Second is the performance of Max, their main streaming service. Are the synergies they talked about after the merger actually materializing? They need to show that combining everything is leading to real cost savings and solid, predictable growth for Max, especially as they try out bundling strategies and leverage that massive library they have.
Okay, and the last of the big 5 is Paramount. What are the key concerns or focus points for them this quarter?
Paramount's in a slightly different position, maybe seen as a smaller player among these giants. So for them, Q3 analysis is really focused on cash flow from
content licensing. Basically, how much money are they making selling their shows and movies to other platforms? That's become a crucial revenue stream for them. And, related to that, their overall debt situation. The market's basically trying to gauge if they have the scale and financial footing to compete long-term with the bigger guys. Strong licensing deals would give them a bit more breathing room to keep investing in their own content and platform.
So, pulling it all together, that record $1.2 billion for horror tells us audiences are definitely showing up for certain experiences. They want content. But these Q3 previews for the Big Five, they tell us whether the companies can actually afford to keep making and distributing that content at the current scale. It's like the financial reality check that determines if the next Black Phone 2 gets greenlit, or if the risk of another M3GN 2.0 makes them pull back. It really is a feedback loop.
That really sums it up. That's the framework for understanding the tensions in the media industry right now. On one hand, you've got the undeniable theatrical power of genres like horror, reliable, communal, good ROI.
And on the other hand, you've got the financial scorecards, those Q3 earnings for Netflix, Comcast, Disney, WBD, and Paramount. What they reveal will really shape investment decisions, content strategies, everything for the next cycle.
But this whole discussion, the record box office contrasted with a specific sequel failing, it leads to one last kind of provocative thought.
Yeah, let's hear it.
Well, we talked about the genre's overall success, built on thrills and often new concepts.
Great.
So does the fact that a highly anticipated sequel like M3GN 2.0 underperformed, does that suggest audiences are actually craving more risk now, more novelty, even within familiar genres?
Are they maybe starting to punish predictable franchise entries, even in horror, and rewarding things that feel genuinely new or surprising instead?
That's the question to think about. When the overall genre strategy is clearly working, hitting over $1 billion, why do some specific sequels, built precisely on familiarity, stumble? Is true originality becoming the key driver for reliable returns, even in a genre we think of as built on certain predictable scares and tensions?
Something for everyone listening to chew on. Great question. Okay, thanks for diving deep with us today. We'll catch you on the next one.